All right, time now for ETF Spotlight. Our Mike Santoli taking a look at high dividend stock ETFs and why they haven't offered that much shelter from this current sell-off. Mike.
Yeah, David, a little bit counterintuitive, right? We've had obviously bond yields collapsing to year-and-a-half lows. You had utility stocks, as you see here. The XLU has done very well this month. This is a month-to-date chart of these ETFs. But the Divi, DVY, that's the iShares Select Dividend ETF. SDY is the S&P 500 Spiders Dividend Aristocrats ETF. They really haven't helped you out much relative to the S&P 500. Why is that? Well, what's inside these ETFs is a lot of financials, 15%, 16% in each one of them, consumer discretionary industrials. In other words, what utilities give investors, at least the perception is, extremely predictable cash flows, recession resistance. What you don't get when you talk about financials and industrials and consumer is that same kind of equation in terms of predictability. So they haven't really done that well, even though the yields are good. The Divi is a 3.5% dividend yield. SDY is more like 2.5%, still premiums to the 10-year note. Look on a one-year basis, it's a relatively similar story. You had new highs for utilities, but the rest of them are basically the S&P, give or take a little bit, with, in particular, the Divi, a little more value-oriented. By the way, Ford Motor Company, the leading holding in the Divi, underperforming by quite a bit. So obviously, it's been a chase for yield, but investors have been discerning about where they want to get that yield from, guys.
Mike, we've talked about at what point some of these staples and utilities and real estate will start to see some sell signals. Anything soon?
Well, yesterday was interesting. You had some underperformance by the utilities, by real estate, despite the fact that Treasury yields made new lows. Sometimes the stock market kind of sniffs out that a move is basically maybe soon going to be running its course. Who knows if that's happening today? You obviously have actually seen already the low in Treasury yields for the morning. It's very early, but I do think you have a lot of stretch sentiment, bullish for bonds, bearish for stocks in the very short term, and I'm kind of alert for a possibility of a month-end reversal.
Yeah, speaking of that, I mean, the S&P now down less than 0.5%.
Yeah.
Apple's come back so far in this session, actually up now, Mike.
Yeah, exactly. So a lot of the bellwethers, a lot of the hard-hit stuff seems like it's trying to lift right now. You really have not gotten any kind of a purge or a flush or anything that seemed like panic. The volatility index has remained very contained in the last week or so, even as the market has made new lows for this month. So it seems maybe the market is saying, you know, it's been more of the same. We've already been under a lot of pressure, and you had sentiment reset quite a bit for a 5 or 6% pullback in the S&P.